My name is Donald Lawrence. I'm a professor at UCL. I work in the computer science department, and my previous life, I was a banker. I spent many years at Citibank working in sales and trading operations in multi-asset in the United States, in Europe, and in Asia. And let me have my distinguished colleagues introduce themselves.
Sure. Good afternoon. My name is Lawrence Johnson. I am head of FinTech engagement and senior vice president at Morningstar. I started my career at IBM, then moved on to practice law in Canada and in the US. I was focusing on technology and finance. By then, working with technology companies, most of my clients were great consumers of other people's money. I moved on, launched a number of startups and with successful exits, and the last one was with Morningstar that acquired a company that I was leading in the data aggregation space. Today, I am heading the FinTech engagement program. I'm spearheading a number of initiatives designed to help emerging growth companies come and see us, enjoy free access to our data, our tools, and learn how to validate their applications.
My name is Vicki Sanders, and I'm co-founder of Research Exchange. Our business is a research aggregator and marketplace, which we set up 3 years ago. Before setting up the business, I built my career on the trading floor doing equity sales. And when the co-founder and I, who was a hedge fund manager, saw research unbundling coming as part of MiFID II, we quit our jobs and set up the business. What was especially interesting about the research side, one of the integral parts to trading decisions, was how little technology had been invested. So our business focuses on that digital revolution, which is just now happening in financial research.
Good afternoon, everyone. I'm Darko, co-founder of Causal Lens. We're a big data analytics platform for investment research. Before that, I was working for prominent hedge funds here in London, and before that, I was doing machine learning in academia. We're doing deep learning before people knew what deep learning was.
Very impressive. So let me just start by giving a little bit of background and set us off to some deep thoughts here. We're in an environment where 10 years after the GFC, there's a massive mistrust of finance. The fourth industrial revolution is about threats to both blue and white-collar jobs. Moore's law is bringing down the price of technology, so we're in a zero, very, very low inflation environment, which leaves us with negative interest rates, which is not something we know even how we're going to get out of. There's a plethora of offerings for saving and investing, offering fraction of the fees of private banking or fund management. Millennials have an intense mistrust for Wall Street. There seems to be an inability for banks to modify their behavior. We find traditional service providers complicated. They find traditional service providers complicated, expensive, and too much effort. Trading technology is a big term, so we kind of broke it down into short-term or high-frequency trading or intraday trading, multi-days or medium-term, which is hours and days, and maybe longer-term in Wall Street is a week or a month or something like that. So the first thing I want to throw out there is there were 3 expensive milliseconds, and this is the fiber cable that was put in under the ground through a mountain in Pennsylvania to connect the futures exchange in Chicago to the stock exchange in New York. 827 miles. It cost millions of dollars, and it saved 3 to 5 milliseconds. So with that, let me throw it to the panel. There's loads of things that are talked about now, like custodian banks monitoring asset flows to sectors and between developed and emerging markets so they have a bigger piece of information. Who wants to start us out with some thoughts?
In my conversations with asset management firms as well as with banks on the trading side of things, what comes up very often is alternative data. As you point out, 3 milliseconds cost a lot of money to invest in, and that was quite a number of years ago now. So where do we evolve to next? If you can't do things faster, then you need to get different data sources. Where you're looking at data and technology, you're looking to find ways of creating time for traders so that they can be doing more of what they do best, which is making those trades.
I just want to point out when it comes to speed, speed usually matters on the execution side of things. It matters less often on kind of the decision-making side of things. And I think we shouldn't forget that 50 trillion of the world's money is managed in a kind of conventional human-driven decision-making where decisions are made and then sure they're executed later with speed of light. But I think it's important to make the distinction between the execution side of things and the decision side of things. The decision side of things, it is more in matter of, pragmatic analysis done by humans, which can take days or months and sometimes multiple months, whereas the execution, it's a speed of light.
I think that's interesting. I'd like to remind everybody that the IMF produced a white paper a few months ago. They were comparing the notion of a thick-skinned and thin-skinned responses to technology speed. And they basically confirmed that technology speed, if we're talking about speed, while it might be creating a divide between the better financed and capitalized firms to the smaller ones, it is actually something that is in the benefit of investors. It turns out that they were able to establish in the FX market, they were able to create a test that basically validated the fact that speed reduces the propensity to respond inappropriately to different shifts in money supplies and in pricing and in news. So it's all good news for everybody.
Good stuff. Is anybody here from Essentia Analytics? Okay, I hope I don't misquote you. Essentia Analytics system, which is using machine learning and AI, looks for patterns of each individual fund manager in a fund management company and looks for signals that indicate their bias. So it tries to take some of the bias out of fund manager behavior for professional institutional managers. So for somebody who's good in a long market but doesn't know how to, is not quick enough to make a decision to go the other way, or how they deal with reversal of markets. Anybody have any comments to talk about that fund manager bias and this whole argument about man versus machine?
I think when you look at how technology can help, and particularly on trading floors or even on the slightly quieter research department floors or where fund managers are sitting, there's a lot of technology that's available on the trading side. That investment over the last 10 or 15 years in terms of HFT and in low latency, or even electronic trading. When I started on the trading floor, we used to have tickets attached to our seats, so you'd grab a ticket and write a ticket. Now, that doesn't happen anymore. And I think you're starting to see technology which is coming in around the ancillary services of how you execute a trade. We operate in research. So we don't do any research ourselves, but we have hundreds of research providers who are selling research to asset management clients on our platform. Now that research is changing. So it used to be that financial research was largely banks and how well they knew the management team or how well they knew the industry. Now we're seeing businesses which are using technology to actually be the source of their research, using new data sets. So if you can, for example, put a mole on consumers' emails in the US, then you can track their receipts, and you can get a better estimate of what Amazon sales are going to be every day than any research analyst at a bank. And what Claire is doing at Essentia is really interesting, looking at fund managers and their behavior in terms of how they can get that extra basis point of performance by evaluating something which isn't the cost of execution, which isn't the TCA side of things, but is actually why they've made that decision and making them better decision makers.
I thought it was just a quick one. I thought it was brutal to send an electric shock through his chair when he did the wrong thing. Sorry, go ahead, Velko.
I think we live in a very, very dynamic financial market, and there's a huge value in trying to bring kind of conventional and alternative data sources into one place. Having them all in a kind of a uniform way suitable for analysis across a plethora of kind of new techniques such as machine learning. I think we're very privileged to be living in a time where computing power is sufficient enough to be able to run a number of predictive algorithms on a very large data set, all in a concurrent manner. And I think there's some very interesting insight that comes out when you do this exercise, when you pull conventional, traditional data sources, alternative data sources into one place, and you run hundreds of different predictive algorithms. It is very interesting what comes out of it. And I think this use case of how a portfolio manager or a fund is performing comes out very clearly when you do this this exercise. On the man versus machine, I don't think is the right question. I think it's not man versus machine, it's a machine versus a man with a machine. And I think that the human have lost a long time ago. Now the humans that will do well are the ones that are going to learn how to interact with a machine in an optimal manner. And I think for the short to medium term, the human and a machine approach is probably going to outperform just the machine approach, in my opinion.
Yeah, I think you're right. But I would argue that AI by itself is not sufficient. All the major players, and probably including your company, have learned to combine and stack AI with other types of analytics, including behavioral science. And it's only when you compound and layer and stack these different technologies, fundamental technologies and insights, that you really get the true picture of what is happening, what the engine is going to be able to deliver at the end.
I think there is, just to add to that, there is an interesting article in the FT, I don't know if anyone read it, about robots on the trading floor. And at UBS, the IT division went to the traders, they went to the front office, and they said, what do you need? We have all this technology, how can we help you? So they put a robot on the trading floor, and it does post-trade allocations. It's freeing up time for the traders to focus on execution, and it's upskilling them by introducing technology.
It sounds like Alexa. Okay, another question. Data analytics firms out there are talking to broker-dealers, and mostly consumer-driven ones, and saying, we have a feed from the stock exchange, and we want to alter that feed for a number of reasons, but is there a way that you can build an algorithm for us that will allow us to include social media trending in the stock exchange data to essentially offer a modified stock price during the day, which is basically the local stock exchange plus or minus social media trending on certain companies that is out there. Does that sound like something effective to people that have been in this space?
I think there are a number of companies that are looking at sentiment analysis. They're looking at being able to distill insights or trends from earning reports. We work with a number of clients that have come to us, borrowed our data to basically validate certain assumptions. And some are doing a very good job. Ford Lane, FinCurate, a few of our clients have been successful in bringing that in. But they spend a lot of time back-checking, verifying and validating the data. I think in this space, there's still a lot of questions relating to how these insights can really predict where the market's going to be going. We are not totally convinced that we are there just yet, but it is one more additional insight that you can basically add to your KPIs or to your dashboard to kind of give you some kind of reading of what will happen. I think that you can only throw that crystal ball so far out, but it will give you some ability to read out or predict some of these macro trends.
I mean, I couldn't agree more. I think sometimes people forget there is no silver bullet in predicting markets, and social media are just a piece of the puzzle, or sentiment in general. It's very important in which macro environment you're using this sentiment. In certain macro environments, it matters more. In other, it matters less. In certain markets, it means more. In certain markets, it means less. And also, we shouldn't forget two things. One, the alpha decay of these signals. It really depends on the nature of trading you do. They might be suitable for a higher kind of frequency type of strategy. They might not be suitable for a kind of longer-term asset management type of strategies. So it's important to get the context of where you're using, and also not to forget that these signals might be already embedded in other signals. So they cannot be looked in isolation. They have to be taken in a multi-dimensional feature space, and only after proper analysis, one would figure out the predictive power of these things.
Yeah, we don't live in a world where we're shy of data anymore. You can stand in a cornfield in the middle of Kansas, and you can get the corn price in every market around the world. What's more important now in the transition that we're in is about what data you're using. And obviously, if there's bad data in, then who knows what the outcome would be. So when it comes to social media, when it comes to being able to scan the universe for all of the stories that are out there, and whether that's on a published news site or on a social media platform, you just have to make sure that it's good data and also figure out the relevance. I've met a number of companies that use social media to write research, and they do have to get down into each post and make sure that if it's about Apple, it's not just about what someone had for lunch.
To add to that, we have at Morningstar 30 behavioral scientists. And the big question we ask ourselves is, how will an asset manager, how will a consumer respond when they get that insight? If your tools and your technology are very good at telling me what's going to happen when, can I train myself to respond accordingly or not based on some kind of primary call to sell or to buy? So the real question is, how is that interaction, that last mile between the machine and the insight and the individual, and how are decisions actually made? And it's not easy. This is not easy stuff.
Absolutely, and because markets are reflexive, what that means is that market participants affect them and the market affects the market participants. I think the behavioral side of things is very important. Just because something works in a back test doesn't mean it will work in the future given the same set of circumstances.
We need an algorithm just to follow Trump's Twitter feed. Another question. The technology is there, but is it being adopted by big players in capital markets? So a lot of the stuff that we've looked at is really consumer-driven. If we think about Nutmeg, many of these platforms are consumer-driven. What about capital markets?
Well, a number of the incumbents were, I'd say, slow to come out of the gate and embrace anything fintech. But over the last 5 years, they've doubled down. They've made substantial investments in infrastructure, in strategy. They have been engaged in the business of transforming their businesses. But what we're seeing, though, is a bit of a divide between the players that have made those investments, have committed to embracing these new technologies, and those that are still questioning whether it's time for them to innovate. And that divide is going to punish a lot of people in the marketplace very soon.
It's interesting if you look at how the LSE, the London Stock Exchange, how they describe themselves these days. They're still an exchange, that's core of their business, but they're a data and technology company. And the technology that a business like that uses is well beyond what many people in this room would understand, and we're sitting with a lot of technologists, I imagine. And I think, though, if you ask the same question to an asset management firm who's more a pension fund manager, what data and technology do you use in your day-to-day? And they acknowledge that they are underdeveloped, that they're sitting on a lot of data that they don't use to the maximum benefit. When they look at their distribution channels, there's a huge amount that they can do to improve, and maybe that's robo-advising, or maybe it's something different. But there are definitely pockets within finance which have been very light touch on technology thus far.
I absolutely agree with that analysis. I think one point I'll make is that a lot of organizations try to innovate from the inside and try to build data science teams and kind of to build the capabilities. But what we find is that that impulse comes. It's easier to integrate in organization when it comes from the outside. It's hard to get that innovation from the inside, and maybe they have been skeptical in the past to work with new kind of startup type of organizations. But we do find that this is kind of the easiest way for large corporates to bring innovation in-house. So I'm speaking to the people with our large asset managers and hedge funds we work with. They've tried to innovate from the inside, and in most cases have failed to. So now they're looking for another way, is bringing kind of outside talent.
Yeah, I'd have to agree with that. It's a lot easier than it would have been sort of 5-6 years ago to be a fintech and selling into large global investment banks or into well-established asset management firms. And I think there's a recognition, do it yourself only works sometimes, and that with the freedom of being a smaller company, new startups are able to innovate beyond what big organizations can do themselves.
But one of the challenges associated with that is that there's a bit of a love affair going on between incumbents and startups. So you have on one side, you have the incumbents that are in love or infatuated with the shiny startups. And then the startups on their side, they're kind of infatuated and in love with the ability to scale. The problem, though, is that both organizations are not engineered to integrate properly. And I believe that that's the next level, that's the next conversation that we all need to have, and I'm assuming a lot of people in this room are already focusing on this, but this is where the next level needs to happen.
No, absolutely. I think there's a lot of synergies to be gained by startup working with large organizations, and it's probably the only way forward. I would think.
Where we are, we have a couple of minutes for questions. You guys want to get this wonderful group involved? Does anybody have any questions? Yes, sir, in the blue shirt in the back. Please wait for a microphone. Can you just give us your name and your organization?
Hi there. Thanks. Nathan from CFA Institute. Thanks for all your thoughts today. Wanted to get your advice on if you're a young professional starting out in maybe investment management, maybe you've already scaled the heights of a CFA charter, good for you. What else do you need, though, in terms of training or experience today, technology-wise, to take advantage of all this that you're talking about?
I'll start by saying a hell of a lot of effing luck. Anybody want to jump in there?
I would say it's really interesting, the user behavior between younger buy-side professionals and those who are more established. And again, operating in the research space, the comfort with someone who's a bit younger in just finding something themselves. Because if you've been around for 10 or 20 years, you've always had the sell side, your brokers giving you everything that you needed and expecting some trades in return. Now, research on bundling changes all of that. This panel isn't about research on bundling, but you do see a different user type. So I think those people entering need to take advantage of their skill set and how it differs from their peers. That's how they are going to differentiate themselves. They have a lot that they can give to their organizations who haven't taken advantage of all of the data and alternative information that's around in the workflow. But equally, anyone servicing those clients needs to think about how they operate. And if they're much more comfortable operating on an IB chat or any chat system, they might not want you to call them. Which, if you're calling someone who's been around for 25 years, he does not want popping up on his screen.
I won't pick it up.
No.
Anybody else, or should we take another question?
I would say be the digital person. One thing I would do is focus on machine learning. Now, you probably don't have the time or the energy or even the inclination to become a computer scientist or a data scientist. But take up a few classes in, not Python, just in machine learning in general. There's a lot of stuff online right now, and you could do that over the next few weeks. And you will acquire two things. One, you'll acquire the proper language, and then you'll start spotting these issues everywhere you go, because they are pervasive They're already impacting everything we do, and there's a lot of that sitting in your phone right now, and you will have a different kind of relationship to everything around you, and you'll be surprised that you're going to be moving ahead of your class at your office because of that knowledge.
Great answer. Another question? Yes, sir. Two blue shirts.
So yeah, my name's John Booz from BitGo, and one thing we know about trading is it comes in cycles, and so you saw sort of this emergence of alternative investments. I still remember when hedge funds became a trillion, then 2 trillion. Just this past April, the ETF marketplace surpassed hedge funds because the returns have been, well, we know that story, about $4 trillion in ETFs. So, and you saw the cycles in the 80s with the, leveraged buyout carries that got killed by, sort of government regulation and taxation. And so the capital markets have always moved faster than the regulation. Now it appears the technologists and the technology is moving faster than the capital markets. And we saw that with what's happening. So I guess my question to you guys is what's the next alternative investment? And is it going to be real digital assets like mentioned in the earlier panel? The digitization of physical gold at the Royal Treasury. And if it's not that, then what is it?
Well, I think the digital gold will coexist with the physical gold and all the other things that you can trade. And I'm sure there will be more and more things you can trade on public exchanges. But I think technology is a facilitator here. It kind of reveals things which were not obvious before. So if anything, technology tries to make markets more efficient. I mean, it depends on your belief. My personal belief is that markets are never going to be fully efficient, but technology does make them that a little bit more efficient, and it is harder to extract insight in areas where too many algorithms are extracting alpha. So you'll notice that in large caps and kind of heavily traded markets, is going to become more efficient, and less traded stuff that has less technology deployed is going to remain less efficient.
Yeah, so as you pointed out, markets do move in cycles. So I'd have to wonder about active management and how it has underperformed, particularly versus passive, if we're starting to see the tipping point and we'll see a return of active management. And that's maybe under some pressure to look for new sources of information to become smarter, more intelligent investors. And the other thing that I see as a trend is actually investing in private companies and early stage businesses. And there are startups out there facilitating those investments for ordinary individuals or also for asset management firms where you would have made so much more money had you been able to invest in Facebook pre-listing when it first started out than since it's listed.
I would echo that. I believe there's a trend right now, and actually we see it at Morningstar. There's a demand for information about private equity. There are new platforms being created by a number of players, including NASDAQ. There's a number of private equity plays that are based on blockchain platforms and strategies. We went out and we acquired a pitch book a few months ago because of the demand for private equity information. So that's something that I would be looking at very closely.
Ladies and gentlemen, thank you very much. We're going to get kicked off by the big guy. So thank you all very much for your attention. Have a great afternoon.